For example, in an organization, the amount of income is 300,000 rupees. Well, the sales revenue is amounted to rupees 2 million, while the invested capital amount in total assets, invested capital in total assets is amounted to rupees 3 million, while the current liability amount rupees 20,000. The cost of capital is, for example, 9%, and the tax rate is 40%. From this data, we have to calculate the number one, sales margin. Well, the formula of sales margin is income upon sales. In this case, the amount of income is we have 300,000, while the sales revenue is 2 million rupees. Multiplied by 100, it means the sales margin is 15%, or rate on return on sales. The next, for example, performance measure, we have to calculate the capital turnover. Well, the formula of capital turnover is sales upon invested capital. The sales revenue is 2 million, while the invested capital amount is 3 million. 2/3 means 66% or 67%. It is capital turnover. The other measure is return on investment. Well, ROI is equals to income upon invested capital. In this regard, we have income of 300,000, while the invested capital is 3 million. It means it is 10%, or in other formula, ROI can be calculated by sales margin multiplied by capital turnover. Sales margin is 15%, while the capital turnover is 67%. The result would be the 10%. The next formula is to calculate the residual income. How to calculate residual income? You can see that the residual income would be calculated by operating income. The division operating income is rupees 300,000 minus its cost of capital. The amount invested is 3 million, and the cost of capital is, in this case, 9%. it means the overall cost of capital is 270,000. The residual income would be rupees 30,000. It is our residual income. The next performance measure is economic value added. Economic value added formula would be income after tax minus total assets minus current liability multiplied by weighted average cost of capital. Well, income after tax, we have 300,000 before tax income into 1 minus tax rate, which is 40%. We have income after tax minus we have total assets amounted to rupees 3 million, while the current liability is 20,000, multiplied by weighted average cost of capital is 9%. By substituting these formula, we have the final result is 88,200 in negative. It is called economic value added.